Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified, episode 24. Wow, 24 episodes already. So what are we talking about? Well, I have so much to talk about. I was going to name this Random Thoughts, which is actually the name of my column over at DaveLandry.com, but I decided to call it Surviving and Prospering During a Bear Market. Now, I have so much to cover, but keep in mind that everything I'm going to talk about, I have talked about previously, and I will follow up in upcoming shows. By the way, I do take requests. Makes my job a lot easier if you tell me what you want to hear. If you need to find me, davelandry.com/contact. If you would like the slides and enough information to keep you busy for a while, and I think I'll throw all three of my books in PDF format too. So go to davelandry.com/StockCharts, put your information in, and you'll get the slides from this presentation, all the prior presentations, all 23 of them, and a bunch of other goodies to keep you busy for a while. Now, before we get started, a couple things. I want to show you some things relative to this market, but more importantly, just keep in mind that these will apply to future markets and other markets or other markets, just in case I get hit with a beer truck, or more likely, my wife kills me while we're in quarantine. If anything appears to be in hindsight or pouring salt into wounds, I'm not doing that, believe me. But do use these things as a learning example for next time. So this is a fluid situation, obviously. So what I started doing, nearly every day I'm putting out an update. If you go to my website, davelandry.com, and the rest of that URL, the easiest thing to do is just go to the menu at the top of the screen for bear market updates. You can keep up with my latest updates there. So I woke up this morning thinking I haven't done a mystery chart in a while. Now, mystery charts or charts that I am personally looking to trade, these are not in hindsight, and they're also stocks that I have usually recommended in my trading service. So none of this is in hindsight. In fact, it's kind of interesting. I was going through the mystery charts a while back, right before all this mess got started, and I started putting together a presentation on how the mystery charts have done. And most, believe it or not, knock on wood, have done incredibly well. Now, it's not always this good, but so far, so good. Again, knock on wood. And occasionally I am quite wrong. Believe me, I get my butt handed to me a lot. But so far, I've been pretty amazed at how well these mystery charts have worked out. Now, let's take a look at the first one in here. We got a really, really nice uptrend. We got a deep pullback. Now, a lot of times I won't trade a pullback quite so deep as you'll see on these charts, but there's a reason for that, and that's going to be revealed in upcoming shows. And by the way, when I started revealing these mystery charts, you guys have figured out a lot of what they are ahead of time, and I congratulate you for that. So I'll make it a little bit more difficult. In fact, I'm kind of tricking you a little bit today in case you're wondering. And if you look further into this presentation, especially if you download the slides, you might see the actual parameters and be able to figure out what these stocks are. Anyway, this one here, nice uptrend followed by a deep pullback. We've got a buy at this level here. We could be wrong. As we know, on any given trade, we could be wrong, so we stop down here. And then the initial profit target is up here. Now, remember, the initial profit target is where we're going to sell half of our shares. And at that point, we don't wait until it hits it to move the stop up. But if the stock moves in our favor and hits the initial profit target at that point in time, we are to break even on the stop. And that's so we can sort of play with the market's money, so to speak. I hate to use those terms because it sounds kind of like a gambling term, but for lack of a better term, somebody else, Charlie Kirk gave me a term, free rolling, which is also a gambling term. But I like that one too. Now let's take a look at this other one. As you can see, really nice uptrend, followed by another deep pullback, giving us a buy at this level here, a stop down here because we could be wrong, right? And then an initial profit target way up here. The idea with these deep retracements like this is that they have the potential to return back to their prior highs, and that's why I like all three of these stocks. In fact, as I was recording this, I hit pause, went over to my screens, and I put in orders to buy, and I'm making little air quotes in the air, there's a little hint, all three of them. And I think we'll have some fun with these. Here's another one here, same sort of action going on, nice thrust higher, deep pullback, initial profit target as you can see up there. We got an entry here and then a stop down here. So I'm really looking forward to following up on these mystery charts in the future. And again, not to tease you too much, but there are the parameters later in this presentation. Serves, or last Friday that is. Now in trading, like in life, it, spelled with a silent SH, goes south fast, really fast. If you would have told me a month ago that I'd be stuck at home binge watching a series about a gun-toting redneck on meth with a dyed blonde mullet who's a polygamous homosexual, not that there's anything wrong with that, who runs a zoo with over 200 tigers and is fighting with a murdering, now this is allegedly, don't spoil it for me, crazy biatch who allegedly fed her husband to a tiger, and she also has quite a few tigers herself. I'd have thought you were crazy, but things change quickly. Now, here's one thing I was thinking about. It usually gets bad before it gets worse. And I think that Abe Lincoln probably would have been a pretty good trader. The best thing about the future is that it comes at you one day at a time. Obviously, famous Abe Lincoln quote there. Now, although things go south fast, really fast, usually there's signs and signals at the turn. Things get bad before they get worse. And at the most basic level, boiling things all the way down to technical analysis 101 and why technical analysis works, at least the most basic form. I'm not talking about 15 oscillators and counting waves and all these other crazy things that a lot of people do. Nothing wrong with that, just not my shtick. I try to keep it as simple as possible. Hence the name of the show, Trading Simplified, right? But at the most basic level, a market is going to lose 10% of its value before it goes on to lose 50% or more. So we take a look at the S&P. We were going along very swimmingly for a long time, just kind of grinding our way higher. A few little corrections here or there. But then obviously market loses 10%, then it lost 20%, then it lost 30%, and then it went down to lose as much as 35% so far during this bear market slide. Now, I've watched the Navigating a Bear Market presentation probably 3 times now. It's been really good. That's StockCharts.com channel, and you go to the special presentation, which I was humbled to be a contributor to. Anyway, Arthur Hill, one of my favorite presentations in there, talked about Charlie Bolello and Michael Gayard, how they did a paper and they talked about how bad things happen below the 200-day moving average. And that got me thinking that bad things happen below the 10% line. Now I'm going to rush through this kind of quickly just to meet the time frame I'm allowed here. But I did spend a lot more time on this in last week's Dave Landry's The Weekend Chart. So if you're interested in that, check my YouTube channel. But thinking along the lines of Mr. Bolello and Gayad, and I'm hoping I'm pronouncing their names right, bad things happen below the 10% line. And the 10% line is just simply a 50-week closing high less 10%. So if you look at this chart, and I'm working with a programmer to bring these indicators, if you want to call them that, to you. It's just a little price reference point is probably a better name. But the point is the green line is the 10% line, meaning that it's 10% below the 50-week high. And you could see that below the green line, bad things happen. There are some whipsaws here and there in between, but as a general statement, bad things happen. Even in 2019, that was a pretty nasty spill below that 10% line, especially for a market like the Russell 2000. And you can see the recent slide was pretty ugly. So in this graphic form, and somebody was asking about the x-axis on this, the x-axis is to the right. Those are percent loss. So you can see 10% loss. I have that highlighted in this illustration. And this is a 20% loss, and this is a 50% loss. We're looking at the S&P 500 on a weekly basis, going all the way back to the early 1900s. And you can see that bad things can happen below the 10% line. So obviously the Great Depression, market lost 86% of its value, while it lost 10% of its value before it went on to lose 86% of its value. Now that doesn't always happen, but as you can see, some bad things can happen below that 10% line. In more recent times, in 2009, obviously went below 50%, and the NASDAQ in 2000 actually went below 70 something percent as far as losses. Now, if you look at where we are in 2020, a little hard to see, so I've zoomed it in here, and you can see that the market has dropped over 30%, obviously, in this slide. But notice that it dropped 10% before it dropped 30% plus. So what I would say is, not in hindsight, because we've been looking at this indicator for years, but next time you need to watch for where bad things happen. Now, keep in mind, 10% is based on the volatility of the overall market. So if you're trading a little biotech stock or something, that 10% would be irrelevant. Might be 20%, it might be 30% or 40% or more based on the volatility of the market. But based on the volatility of the S&P 500, 10% is a pretty good reference point. Once it loses 10%, you really need to pay attention to see if things are going to worsen from there. Now, I woke up a couple days ago thinking about the emotional cycle of the stock market, and I got to thinking, this can't be original thought. So I did a little Googling on that, and there were plenty of charts out there, kind of look like sine waves, where they explain all the emotions and everything that happens in a bear market. So I thought I would just kind of simplify that with just a few little things that happen at tops and bottoms. So when the market is kind of going along swimmingly and just kind of chugging along and going higher, it can be priced for perfection and promise. Now, what I mean by that is, let's say some big cap stock actually does make widgets and sell widgets, or whatever the case may be, have a product in the market, I think is what I'm trying to say, and they have fundamentals. I know I just said the F word. But the analysts will be looking at that stock, and they'll be looking at the earnings, and it's priced for perfection. Not only is it priced for perfection, meaning they have to meet these expectations, these stocks actually have to exceed these expectations, because the market sort of looks ahead and gets a little bit ahead of itself and overprices these stocks. So what happens is there's a bit of a permanent income hypothesis looking forward, like it's always going to be this good and always going to be this way. Now, I added in that "and promise" because stocks that I like to trade, such as IPOs and small cap stocks, which are sort of just the opposite of what I like to short. I prefer shorting big cap stocks. And if we have time, I'll explain that in just 1 second. Anyway, the reason I put promise in there is because some of these stocks, I wouldn't know a fundamental if it hit them in the butt, or trading at these high levels. And that's because there's some sort of promise of the future with these stocks. And that's why I named my IPO course, IPOs, the promise of the future. Now, when things begin to tank, the first thing happens is denial, disbelief, and deer in the headlights. Now, I'm talking about a little bit more than just a little generic correction or generic pullback along the way. When things really begin to come unglued, let's say we drop 10% or more, like I just discussed. Now, when things really begin to go south, you end up in a state of despair, or as I thought it'd be kind of funny to call it, disbear, like this bear market, right? And then things really get kind of overdone, and everybody just thinks that we're just going to go to zero. And at that point in time, there's blood in the streets. Now, after that happens, or as soon as there's blood in the streets or perceived blood in the streets, the market somehow shrugs it all off. The point I'm trying to make is, a lot of times a bear market will bottom on really bad news. And that's an old stock market adage. Now, this is something that you can't trade off of, but it can help you to wrap your head around where we might be. Okay, we're going to take a quick break. And when we return, we're going to talk about, so where are we now? So where are we? Well, I think we're probably closer to blood in the streets. And boy, it sure seems like it, right? But that doesn't matter. As I often preach, it's often darkest right before it gets more dark. I'm doing little air quotes for more dark. I know it's bad English. But what I suggest you do is watch for signs and signal. Now, signals. I would use objective signs and signals to help you gauge where you are in the market. And just use simple things. And again, we don't have enough time to go into details on all these, but I have in prior presentations that I have on my website. So there's plenty of information on all this. But look at the order of the moving averages for downtrend, proper order. The 10 simple is less than the 20 exponential and 30 exponential. And then the flip side of that, 10 is greater than 20, greater than 30 for uptrends. That in and of itself can keep you out of a lot of trouble and help to keep you on the right side of the market. And I picked those moving averages because after studying many moving averages, I found a really cool relationship between those, and that's the bow tie pattern, which we discussed in one of the earlier shows. Now, the TFM 10% system, really simple. Unfortunately, though, it might take a long time before we get a buy signal with this based on the magnitude of the slide, because it works off the 50-week high, and it's going to take 50 weeks before that high starts coming down to get a buy signal. And that'll make a little more sense if you go in and watch the presentations that I did on that. Landry Light, talked a lot about Landry Light in the Navigating a Bear Market and in prior stock chart shows, so take a look at those. And that's just the lows are greater than the moving average for uptrends, and the highs are less than the moving average for downtrends. Use your favorite one. For the overall market, I actually like to look at something like a 50-week simple for the much longer term trend, and then things like the bow tie moving averages on the daily chart for shorter term trends. Now, we've talked about this before. Patterns are fractal, and in this case, this is an hourly S&P. You could see that the 30 was below the 20 and the 20 was below the 10. We were in a downtrend on hourly, and then look at those things, how they turned around and flipped over to the upside and formed what I call a bow tie. A little sloppy because it wasn't really tight, but you could see that, again, the 10 was less than the 20 and the 20 was less than the 30, and then now the 10 is greater than the 20 and 20 is greater than 30. And usually, if you look to the top of the screen, I usually like to see them come together really tight. In other words, look like an actual bow tie and then spread out again. But technically, this is a signal. We had the lower low and a lower high on the hourly charts. In other words, a 1-bar pullback. And the market has, in general, traded higher from there. Now, one more point. Let's take a look at the order of the moving averages. For a downtrend proper order would be 10 simple is below the 20 exponential, and the 20 exponential is below the 30 exponential. Now, keep in mind, this is an hourly chart, but as I often preach, what works in one time frame works in others. And downtrend proper order, again, 10 less than 20 less than 30. When things flip over, and that's what forms our bow tie, then the 10 is greater than the 20, and the 20 is greater than the 30, and that's uptrend proper order. Another really simple thing to look at is Landry Light, and if you look to the left of this chart, you can see the highs were less than the moving average, and then after things flipped over with the bow tie, you can see that the lows are greater than the moving average. You can see light between the lows and the moving average for uptrends, and light, so to speak, or a gap, whatever you want to call it, between the highs and the moving average for downtrends. Now, here's the thing. Should you buy the hourly signal? I'm going to say no, even in hindsight, even though in this case it worked up until now, I think, with the futures are week pre-market. I'm recording this on April 1st, 2020. But what I would encourage you to do is use it as a heads up, like, hey, maybe we are beginning to head higher, but don't fight the big blue arrow. In other words, the big blue arrow still points down. You get an hourly signal that suggests that you might be in a retraced rally, and you probably want to honor your stops on your existing shorts, and then again use it as a sign that the retrace rally is on the way. Now, the next hourly signal to the downside could suggest that the retrace rally is done and the big blue arrow is once again going to take over. So I would make sure you pay attention to that signal, but not necessarily trade off of it directly, but just kind of use it as a reference to let you know where we are. So how am I playing this? Well, I play it like I normally play it. My trading simplified approach, which I actually put on a cocktail napkin. If you understand this napkin, you pretty much understand my approach, is thrust, pullback, hopefully rinse and repeat, and we take initial profit targets along the way. And we also have a stop and a trailing stop for when, not if, we are wrong on the trade. But hopefully we get that initial profit target first, so we just are able to free roll or play with the market's money, so to speak. On the downside, it's the same exact thing. So thrust, pullback, rinse, and repeat. So what do we have here in the overall market? We have a thrust followed by a pullback. So I am shorting the market. Now, shorting is a little harder than it looks, as I've said quite often. Many times, as I said many times before, when I first got started, I did really well for a while buying stocks, and then I started losing money. And I discovered this thing called shorting. I'm like, well, hell, I'm losing money anyway on my trades. If I was shorting these stocks, I'd be making money. Well, I quickly found out that shorting was a lot harder than it looks. So a few words about shorting real quick. Again, it's more difficult than it looks. It's tough to ride out the trends longer term. My ultimate goal is to ride out a trend for weeks, months, and hopefully years. But in shorting, you have these sharp retrace rallies. The value guys come in at some point, the bottom pickers, and then that quickly gets exacerbated and the shorts rush to cover all the same time, and the markets go straight up for a little while, and then of course they turn right back down to frustrate you. Now keep in mind you have 100% max profit. We had a few shorts we started off with, and I'll show you the portfolio in just a few minutes, that were up in the double digits, 20 something dollars a share or whatever, but then they went down to single digits a share. Single digits, in other words, less than $10. And some clients were like, Dave, should we just shut them down? And that's an interesting point to think about, like how much the bloom is off the rose, or however you want to look at it, how much, juice is left for the squeeze. So the maximum you can ever make if the company goes bankrupt is 100%. Now you can reset your positions. That's a little bit more complex than I want to get into today, but let's say they pull back a little bit. You could put some shares back on and then trade around those core positions, so to speak. Now, people against shorting argue that you have the potential for unlimited losses. Well, first of all, you would have to have unlimited money because your broker would ask you kindly to put money in the account, or he would exit the position kindly for you. So you have to be stupid, obstinate, and have an unlimited amount of money in order to lose unlimited amounts on the short side. But yes, if you buy a stock, it goes to zero, you lost all of your investment. If you short a stock and you're obstinate and it keeps going higher and higher and higher, you can lose a lot more than what you initially put up. Now, there is some logistics involved. A lot of cases recently, for instance, I had some stocks I wanted to short, so I just go in and willy-nilly kind of just try to short 100 shares just to see if I can get them. And a lot of cases, I can't get the stock. So you have to borrow the stock. There's also something called the callback, which the shares can be called away from you. Now, it sounds like a big pain in the butt, and it is, okay? So the question is, why short? Well, obviously, it's the only way to make money in a down market. And the big reason here, as I say quite often, is it really, really helps you to see both sides of the market. During this fantastic uptrend we've been in, a couple of shorts showed up, and I said, you know what, let's give it a shot. We did. Those were some of the mystery charts that I showed in prior. In fact, all of the mystery charts on the short side that I showed prior to this presentation. The point is, if you're if you're used to looking at both sides of the market, then you are able to see both sides of the market, and you know when things are beginning to turn south. My friends who run hundreds of millions of dollars, who are long only oriented, which is nothing wrong with that, but they tend to always see the market as glass half full. Question, do you want to go sailing? And I'm borrowing a line from Arthur Hill's presentation. So you want to go sailing? Well, let's check the weather. Do you still want to go sailing? So Arthur Hill recently said trading in a bear market is like going boating in a hurricane. So what I would encourage you to do is learn, and tread lightly. Now, I've received a few emails, and I'm watching I have the advantage of seeing a lot of traders do a lot of things. And somebody recently emailed me and said, my first trade, my first Dave trade, that is, following my methodology, was VIXI. Can you critique that for me? And my point is that, well, wait a minute. This is a derivative of a derivative of a derivative, okay, type of stock. And it doesn't necessarily act like a normal stock. Not that any stock acts normal, but the point is this is a very complex instrument that doesn't necessarily trade in trends and normal technical analysis. It's more of a kind of a reversion to the mean market. You're actually trading volatility, which is very, very, very complex. Somebody else said, I traded a thin, triple leverage, inverted bear shares, and now the delisted. What do I do? Well, that's another one of those kind of crazy leverage derivative things. And in his case, this poor guy traded something that was really thin, and now he's stuck with it, and he's going to have to wait for a check when everything settles out. Along those same lines, some people are like, hey, my account's real small. Should I start trading options? Well, option prices have gone through the roof. The implied volatilities are through the roof. Historical volatilities are through the roof too, but I think the implieds are a little bit out of the line. In other words, options are ridiculously expensive. And it's always really hard to make money in options as a general statement, but I think in this market it's going to be even harder. Now, I would encourage you not to trade off mechanical systems such as the bow ties and the Landry light and all these things I preach about, but do watch for objective signals so we know where we are. And look, don't be afraid to ask for help and get educated. I still get a lot of help from other traders. Like I was just saying, I still learn a lot. I've watched the Navigating the Bear Market thing several times, as I just said, and really enjoyed it. You don't have to be alone in this. Psychologists have pointed out that we are social creatures, which is going to probably have some problems eventually with the social distancing problem we're having now. But we are social creatures, and trading can be a very, very lonely sport. I do have a Facebook group, but you have to be a gold member. It's free, but you have to be a gold member. And then what I would encourage you to do if you do become a gold member, and it's cheap, but I would take all the gold member courses and get up to speed. Somebody just signed up a couple days ago, and they said, hey, Dave, let's have a phone call and tell me how to get started. It's like, well, we could still talk, but why don't you go through these courses, and then why don't you bring up some of these questions in the group so not only I can chime in, but a lot of other traders with a lot of experience can chime in too. Now, just real quick, the question is, how did my model fare? I run a model account on a hypothetical 100K account, although I do keep an account which is roughly this size to make sure that these things are actually working in real market. So most of these trades are actually real trades of my own too. So the model right at the market peak was up 19,155, and then I did a mark-to-market yesterday, that is, and it was at 11,757. So we do the math on that. So you're looking at a loss of 7,398, and this is on a 100K account. The good news is the trades that stopped out since the top, including one short, which is a bit of a bummer, and a little discretion would have kept you in that short, but that's another presentation altogether. But looking at all the longs and shorts that have stopped out since then, -1 is a short, 1 is a long, you can see that there was a gain of 8,176. These are profits and losses that have been locked in. So if we add that in, it's not much to brag about, but my Cajun just slipped out. There's actually a joke about that, but we'll discuss that some other time, maybe over a beer. Anyway, there's a gain of $778, or about 0.75% if you're looking at that 100K account. So that's better than a poke in the eye through all this mess. So I want to thank everybody for watching. May the trend be with you. Everybody stay safe and stay sane during these crazy times. Thank you so much.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.